This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Well, we have a series of shows for you over the next few days that I know you are going to enjoy. You're going to learn a lot, no matter what stage in this business you are in. Our guest today he came from many years on Wall Street, and he learned so much from there that he's going to share with us that's helped him in commercial real estate, but also he's going to talk about his transition into commercial real estate and how maybe he wishes he had done it a little differently. He's going to share that with you in case you are getting started. You're going to want to hear that. He also talks about, first hires compared to hires he just recently made and how he looked at those, how he afforded them. Then we get into deal sourcing. And then we get into broker relationships. I mean, how they're finding deals. And he goes into detail. And then finally, we also talk about the economy, the market. What is he looking at? How is he finding this information? What's changed in his underwriting? Man, I wish I had heard many of these things a long time ago, right? And I know that you're going to learn a lot. Whether you're a passive investor or operator, you're going to learn a lot from these next few days. His name is Craig Berger. He founded Avid Realty Partners in 2015 after spending over a decade on Wall Street as a multi-award-winning equity research analyst. The firm's portfolio has grown meaningfully in recent years and includes acquisitions of over 1,450 apartments, totaling more than $210 million in acquisition value in targeted growth market assets across the U.S., in addition to even a few hotels and net lease assets. So Craig's done a number of different things in real estate, but they're growing quickly, as you are going to hear, but he provided some great insight through this series. I hope you'll stick around for all 3 days. If you're involved in this business in any way, I know you're going to learn a lot. Craig, welcome to the show. Honored to have you on and get to know you a little better. I know we have crossed paths numerous times at different events, and it's been neat to hear more about your business. And so I'm looking forward to doing this series with you, and so listeners can learn more about you as well and learn from you. But first, Craig, tell us a little bit about what your kind of business you're in, what you're doing, and then let's talk about how you got there. What was before real estate?
Awesome. Whitney, thanks so much for having me on. I really appreciate it. And you've done so many podcasts, so honored to spend some time with you. In terms of who I am, well, I grew up in St. Louis, Missouri. I spent 12 years on Wall Street as an equities analyst, writing research and providing advice. That was fun. And I guess after you do things long enough, sometimes you want to make a change also. Today, I'm a multifamily guy. We've acquired about 2,000 units. We've sold off a chunk of those units, and we're intently focused on growing the platform, hiring, scaling, and trying to make lemonade in 2023.
Awesome. Yeah, that's great. Hiring, scaling, and the listeners always want to know about those things. But, you 12 years on Wall Street. Wow. And then making a switch to commercial real estate, specifically multifamily. What caused you to switch? Let's talk about, switching from Wall Street, being so focused on Wall Street, right? I mean, a career there for 12 years. And then, just complete pivot to commercial real estate. Tell us about that.
Good question. Sometimes when you do something, you just get super focused and you get like tunnel vision and you can't see anything else that's really going on. And, when you work 14 hours a day trying to be successful, you can get caught up in that. But look, Wall Street was a great experience. I learned so much, and a lot of that I take forward with me to real estate. But a few things. One, I wanted to make a change and do something new. Two, I really wanted to be entrepreneurial and work to build something meaningful, something more meaningful than working a desk job at somebody else's company. Not that there's anything wrong with that either. Three, the business that I was in Wall Street was changing and morphing and shrinking and sort of going away, becoming less important. And four, I really wanted to take control of my life, my future, my destiny. And as part of that, do something where I wouldn't be replaced by a computer.
Love that. That's forward thinking.
That was just a few of my thoughts, but it's been an incredible journey filled with a lot of challenges. And had I known then what I know now, I don't know, I might have gone a different route.
Is that right? So it's been that bad, huh? Being in multifamily, it hadn't been the the change that you were looking for, or the meaningful part, maybe, or how
No,
about that?
it's actually great. I'm just thinking back on this journey. It's been tremendous. I'd say I didn't make my transition well. I didn't do it the right way. And I think, having maybe going to work for a large firm with established procedures and processes and market presence would have been helpful. But, after spending almost 20 years working for other people, I didn't want to do it that way anymore. So my bad.
So what would you tell somebody listening right now to, even in those shoes, say they've been doing this career 10, 12 years, and they're going to jump into commercial real estate? Sounds like, you've had some thought about how you made that transition. You say you didn't do it the right way. What would you tell them?
Well, I guess I'd say find a community of like-minded people to join. There's a lot of different mastermind groups out there. There's a lot of different communities out there that are a mix of education plus co-sponsorship and bring you up in a community with support and resources. I'd say definitely pursue that. I'd say get as smart and as educated as you can while you have a desk job, while you're making a salary. Hold on to that paycheck and make as much progress and get as smart as possible while you're doing that. Maybe you don't work 10 or 12 hours for your company anymore. Maybe you're only working 6 hours a day and getting by and spending 4 or 6 hours a day on some of your own activities. I don't know if it's ethical to say that or not, but there's a risk management benefit to getting a paycheck, and that's just reality. And then third, if you do decide you're ready to make a change, going to work for a larger, more established company, I think is helpful to getting experience, sort of achieving personal and professional credentials in the space and so on. So just a few thoughts on that.
Yeah, no, that's incredible advice. Even you're talking about the transition, maybe lessening your hours at your day job so you can work a little more hours. I would say sometimes there are, your supervisor may even be okay with you cutting back some hours, right? And especially maybe if they think they're going into a recession, they may be looking for people to do that, right? And so it may be a great time to think about that.
Absolutely. Look, I don't really support the quiet quitting thing. I know during COVID, some people, especially in tech or engineers or coders, might have 2 or 3 jobs. But, as someone who worked 14 hours a day for other people's companies for 15 years, maybe work a little less and spend a little time on yourself.
Yeah, incredible. No doubt, with your experience and desire to do something meaningful, taking this transition, pivoting this way, you could have gone a lot of different routes, started different kinds of businesses, or even something, your own business in that same line of work, potentially. So why commercial real estate?
Well, I did try a few different things and explored various avenues. What I eventually got to was that, even if you just do fix and flip homes on a small scale, you can create and build a path forward for yourself. I ultimately felt like real estate was something that I could do on my own, where I had a 50-50 chance of survival. And those odds were better than, starting my own tech startup or better than some of the other things that I might do on my own. I did consider going to work for a hedge fund, ultimately passed on that, wanted to try some different experiences, get some different skill sets, but that's a good career path forward for people that were in my position previously. And it's just, that's life, right? You make choices and take different paths forward and give it a go. But ultimately, I was just really looking to hopefully survive and like I said, build something meaningful, which takes time.
What about some lessons or takeaways from your previous job that you were able to move into real estate? How did that help you?
Wow. Being on Wall Street, I think, has been incredibly helpful for me as I work to build a real estate business. So a few things. One, I had the good fortune of living and breathing the stock market and the economic cycles. right? Everything is a cycle, even though this cycle was a monster upcycle from 2009 all the way to 2022. Maybe we'll even have a soft landing here. Really keeping in mind that everything is a cycle is super important. Reading those tea leaves. I had the opportunity to study formal risk management from traders and institutional investors. I had the opportunity to spend a lot of time with Fortune 500 C-level executives when we were out co-marketing to our hedge fund and mutual fund, my clients, their investors / bosses. And these are just sort of, things that you pick up over a decade plus of being on the street. Obviously got to do a lot of deep dive analyses and ultimately developed sort of an institutional mindset. So if I was just starting out fix and flipping at 23 years old, I wouldn't have the same institutional mindset, checks and balances, process control type of thoughts that I've had after spending 12 years at various banks, big banks, little banks, and so on.
Well, if you are just tuning in today to this series of shows with Craig, I hope you'll go back and listen to yesterday. I mean, he had a career in Wall Street, and then he took a massive pivot to commercial real estate and is completely 100% into this business. Now 2,000 units, hiring, scaling. We covered a lot of that yesterday, and he shared even some things about his transition that I was so thankful for, because I get questions about this all the time. He talked about how maybe he didn't do it the right way, but he told you how to do it now the right way. And I hope you'll go back and listen, even his hires, some of his first hires and how he did that, and even some of the current hires, high level hires that he's recently hired, that I know as you were trying to scale your business, you're going to learn a lot from. Craig, welcome back to the show. Looking forward to diving into how you're finding deals and maybe what you think about the economic market today.
Whitney, thanks so much for having me.
I told the listeners yesterday we were going to talk about how you're finding deals. And I know for us over this last year, it's been slow on the deal front. However, it's really been good timing for us. We have done some deals, but it's allowed us to focus a lot internally and build some systems, processes, and things that, have really helped us, I think, in a big way. But we're still looking for deals. So what about you all? Let's talk about, what do you all look for, when pursuing deals? Let's take it kind of basic. What do you look for? What makes a deal for Craig? And then let's go into strategies of how you're finding them.
Wow. What do we look for? Well, we look for an asset that's going to deliver for our investors, number one, something that we think we can generate cash flow and appreciation from, and it must do that. We're pretty value conscious and value sensitive, and that probably cost me some deals in earlier years, and hopefully will have saved me during this cycle some. But we have to create value for our investors. Beyond that, what do we look for? We're trying to build a diversified footprint of A's, B's, and C's, and a geographically diversified footprint as well across sort of growth markets, mostly in the Sun Belt locations. I sort of bucket deals as, could I own this deal long term, which would probably happen through a series of recapitalizations every 4, 5, 6 years? Or is it really just a trade and 4, 5, 6 years and then sell it out? We do want to build scale, and you don't build scale by selling off all of your assets. And so recapitalizing deals that we love in terms of demographics or location or physical condition of a property is something that we think about. But we're looking to create value. We're looking for great locations, hopefully improving locations, growing locations. And, obviously beautiful properties are better than uglier properties, and deals that can be attractive to the next owner is always good. And then lastly, a 400 or 500 unit deal is the same amount of work as a 100-unit deal, and you make 4 or 5 times the progress in terms of scale. So we are gravitating more towards deals that are, over 200 units as sort of a baseline place to start.
Nice. Yeah. Are there any specific metrics that you would say, if it can't deliver this IRR or this cash on cash or whatever, that we're just not even going to look at it?
There's not any one deal breaker. We look at everything when we look at a deal: price per door, price per foot, going in cap rate, year 5 prospective cap rate. Right now with SOFR at 400 bips and bridge debt spread starting at 400 bips, borrowing bridge debt right now at 8% is particularly painful. So we're really not looking at bridge debt deals right now, unless it's just an absolute home run overall cost basis. So that would be one thing in the current environment that sort of is a no. But we look holistically at the asset, and frankly, we've looked at so many deals, underwritten so many deals, sifted through so many deals before we underwrote them, that we sort of have a strong sense for what is value, what's attractive, what's not, and I don't know if that's enough on that, but
yeah, no, that's helpful. I get that question too all the time. And it's not just like this one thing, right? It's numerous things that are going to tell you this is something we should pursue or not. I liked how you also mentioned, is this a long-term purchase, or is it something that we're going to trade? Could you speak to maybe that decision-making process a little bit, or maybe how you're looking at that deal, or why you would take one deal knowing that we're going to trade it quickly versus taking a deal that knowing we're going to keep it long-term?
Sure. It's really just about the location, the demographics, the market growth, and probably the physical characteristics of a property. But, we may not particularly know when we're going into a deal if it's a deal we want to own for 20 years, or if it's a deal where we say, hey, life's too short, let's get out of this one. You might find that out over the course of your first 12, 24, 36 months of ownership, when you have conversations with yourself, when things come up and you figure out, what you really want in life and how much support you have and how the asset really performs. So we recognize that as sponsors, we really make our money by realizing promotes. We have to hurdle a 7 or 8% annualized IRR look back return for our investors. And when we do that, we start to share in the upside. That's when we make our economics. And so to really have resources and money to pay employees and to go do deposits and to go do future deals, you have to sell. And selling could mean you sell to an independent third party and you realize your promote, or selling could mean, again, you recapitalize with a new group of investors and you sign up for another tour of duty with that deal. And so, we need to fund the growth of our business and realize exits. Also, I don't know very many investors that want to be into a deal forever. So even if you love an asset, you still have to at some point transact either internally or externally, unless you're investing your own money, which would be a great place to be.
Yeah. Speak to some of the strategies you all are using to find projects right now or sourcing deals.
Right. So, in terms of sourcing, there's sort of 2 high-level categories. Is it on market and brokered, or is it off market? And there's detailed strategies that we're pursuing within both buckets. Everybody loves off market. It's hard to get true off market deals. I don't mean the same deals that are passed around like bad candy by all of those quote unquote off market brokers. I'm talking about true direct to seller off market deals. Those are hard to source. It's usually if you have a substantial presence in a particular market, you can get an early call. It might be if you're employing virtual assistants or other sort of outbound resources to find and uncover those opportunities, right? The reality is with CoStar, all of the owners' phone numbers and emails are in the system. And now owners are getting multiple outreaches per day, per week. Hey, do you want to sell this deal? You're getting stuff in the mail. You're getting phone calls. You're getting robo texts. You're getting everything. So doing the whole outreach to direct owners is difficult and competitive, and we haven't been that successful with it, and we need to do better. There's also the sort of relationship aspect of sourcing off market, which is, other operators, you've met them, you've transacted with them, or you've met them repeatedly at conferences, or you're in the same circle or tangentially in the same circle, and you reach out to those folks and try to make something happen owner to owner.
I am grateful that you are back with us again today. We have Craig Berger back for this series of shows. And if you haven't listened to the last 2 days, I hope you will go back. He had 12 years on Wall Street, and he talked about that transition and ultimately telling you what he did wrong or what he feels like you could do better to help that transition into commercial real estate. Also, some of the key hires that he made early and then even more recent, in his commercial real estate career and path. I wish I had thought about some of those things early on, and it's still helpful even today. And then we got into deal sourcing. How do they find deals? What's some of those broker relationships look like? How do they do that internally? Which he was gracious to help us see some of the things that they do internally to make that happen. But today, a question that everybody has, Craig, and I was just like, everybody wants to know what's going to happen, right? And I know you've got the answers for what's going to happen. So welcome back, Craig. Honored to have you on the show. Grateful for your willingness to do a series of shows and us jump into a little deeper into some topics of how you operate and helping us learn from you. But, I'd love to know, especially your background in Wall Street and just the market knowledge, that you gained there and how you're applying that to your business now. I would love to, just hear from you. I know the listeners would as well. What do you expect over the next 6 to 12 months? And let's dive into maybe the economy and how is that changing what, you all are doing in-house, or has it?
Awesome. Thanks so much for having me again. You're a great interviewer. You asked insightful questions and I appreciate it. So look, in terms of the economy, it's a really interesting time right now. 2022 is pretty much the first time in history that stocks and bonds have both dropped 20% or so. Usually if stocks drop, you have a flight to quality and bonds hold, or vice versa, risk on, risk off. But this year has really been a sort of unique year in the history of the financial markets. But everybody's talking about inflation and how long does it keep going and how high is it? I have a bunch of thoughts on that. So, here's a few of my thoughts. First of all, inflation isn't 8%, it's like 30%, and the data is cooked and how they look at it and so on. Secondly, the main cause of inflation has been the Fed's Frankenstein experiment gone awry, known as quantitative easing. And a lot of people don't know what quantitative easing is, but during COVID, to support the markets, the Fed started buying bonds from Goldman Sachs and Morgan Stanley and JP Morgan. And what does buying bonds mean? Well, it means that Goldman Sachs wrote on the back of a napkin, I owe you $50 billion, and gave it to the Fed. And the Fed wired them electronically $50 billion of money that didn't exist 30 seconds before. And so the Fed's balance sheet went from 4 trillion to 10 or 11 trillion. First time ever that they bought bonds in that manner with quantitative easing. And so our M2 money supply grew by 45% from the start of COVID to the end of 2021. And that 45% growth in money supply means your money just isn't worth what it used to be worth. And that price is skyrocketed. That's in addition to the government support payouts for COVID, the relief payouts and stimulus checks, and some of the current administration's spending programs, the infrastructure program or otherwise. So just a lot of growth between the Fed and the federal government. And that's why we have tremendous inflation. But today, the Fed has stopped doing that and has reversed it in its quantitative tightening. And they've only sold off or taken those dollars back from Goldman and Morgan Stanley and JP Morgan. They've only taken like 5% of the dollars back. It's been very slow, but it's heading in the right direction. And it's, that along with the meaningful and painful Fed rate hikes is I think starting to have a positive impact on inflation. And I think inflation is more or less on its way back down to more normal levels.
Okay. No, that's helpful. I think, and that right there even shows your experience from Wall Street and the knowledge that you gained from there and how you're able to apply that to what you're doing now. Some insight there that I've had to struggle to learn some of these things, that you were just living in, I think, in that time. But I'd love to know, what are you watching right now? What's important to Craig on a maybe day-to-day basis as you're leading your company and growth, as you're, hey, we're looking for more deals, but what are you watching right now in the economy?
Well, we look at the 10-year treasury on a daily basis. I do have one bridge floater where, we have a cap on that deal. The rest of our loans are agency fixed, fortunately, but we look at the 10 year as a proxy for where cap rates are going. We obviously listen very closely to what the Fed says because Fed speak is critical right now. Don't fight the Fed. When the Fed says they're raising, the economy goes down. When the Fed gets dovish and more accommodative, the economy usually heats up and valuations go up. So we pay particular attention to the Fed. We're obviously looking at all of the inflation readings, CPI, wholesale data, right? We want to know, where's this inflation thing going, right? I think last month, apartment rents, which have been one of the causes of inflation, grew 0.2% month over month. I don't care about the year over year. That's just math, but I do care about month over month because whatever this month's month over month times 12 months is going to give you your year over year a year from now. And apartment rents grew 0.2% across the country. That's a 2.4% annualized rate, and it bodes well for the future of inflation. And so we're really looking at, hey, where do we think borrowing rates are going to be a year from now or 18 months from now? Where do we think cap rates are going to be 18 months from now? And based on all of that data, and how do we play that?
Yeah. Even like practically, where do you find that information? What do you watch every day? Is there a couple websites? Because I get that question too. Like, we know we might need to look at some of these things, or we try to, but where do you find and trust that information coming from?
CNBC.com is probably where I spend most of my time, just for financial news, data, et cetera. There's some others, but CNBC is a great source, thorough, probably the best around. Some people look at Bloomberg also.
And what about, has your underwriting changed, or maybe the types of deals you're looking at, or, from what's happening in the economy right now and what you feel is happening or going to happen, any of those things, how has that changed how you all are looking at projects and moving forward on deals?
Well, our underwriting is always changing. It's always in flux. There's some things that are always the same, but there's other things that are always changing, right? Obviously, we're underwriting less rent growth, less rent pop on renovations, higher exit cap rates. Obviously, we're underwriting the current debt market conditions, which are totally different than they were a year ago. On Freddie floaters, we use the forward rate curve, and the forward rate curve a year ago was really wrong. And, that's just some of the risks of forecasting. But, our model is constantly in flux, and we're, underwriting to higher cap rates, less rent growth, higher interest expense. And we need to hit higher IRRs. A 15 at the deal level isn't really going to work right now. We need an 18 or a 19 so that we can be attractive to potential investors and get them to part with their money during an economically challenging time. In terms of deals, we are probably looking more for A's and B's, just because I think really lower end workforce stuff is folks are spending more of their money on gas and food, and things have gotten a lot more expensive. And so I think it's harder for the Class C communities to pay rent right now. It's unfortunate that the Fed has put us in this position, but it's reality. And I sort of, have to be dialed into reality. So that's some of the things that, have changed and sort of how we're looking at properties right now.
Yeah, no, that's some great information right there. I get the same question all the time. Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.